Welcome to the February update of the Larch Fund, which is my own personal Canadian dividend stock portfolio tracker. In today's episode, we are going to be talking about the portfolio, some of the changes I've made in the last little bit, some of the things I've been buying. I've got the Snowball analytics up to date with some purchases. I can talk to you guys a little bit about how the returns look now compared to they did when this portfolio was first constructed. And I'm going to take this opportunity to talk to you guys a little bit about the news that's been going on, because it's almost impossible for any of us to talk about investing without talking about all of the news that's happening in the investing world, particularly me, a Canadian investing channel who needs to, as part of the channel, be talking about the Canadian economy. And obviously there's so much drama going on right now. Welcome to Golden Arch Investing. My name is Liam. Today's episode, we're going to be talking all about the February update of my own personal dividend investing Canadian portfolio. If this is the kind of thing that interests you, please do subscribe to the channel. We talk about this stuff every week on the channel. We have videos several times a week talking about all sorts of Canadian companies with a particular focus on dividend payers. And that typically gets us into the world of sort of the Canadian resource industries, which obviously can't talk about this week without talking about tariffs. Oh, I know, I said it. I said the word. I've been bombarded with tariff news for days. And honestly, it's getting to the point where it's grinding me down a little bit. I almost made a video talking about the tariffs yesterday when it was sort of finally decided what was going to go on, and obviously Canada's making its own tariffs. And but in my day job, I teach social studies, and so I'm gonna have to talk about it and try to explain this to students tomorrow. And to be honest, I don't want to talk too much about it today. So let's talk a little bit about my portfolio, what moves I'm making, and how I'm putting myself in a position to win in the long run. And I think a lot of that comes down to two key aspects of my investing philosophy. And the first one is patience. It is important to be patient in the stock market. I love the Warren Buffett quote that he talks about the stock market being a mechanism that just takes money from the impatient and giving it to the patient. The biggest compounder, the biggest, most powerful part of compound interest is time. So you can't be investing for short-term gains and hope to constantly make big wins in the short term. Instead, I'm looking for little wins over the long term that will pile up much bigger. That's my philosophy. And you know what? It's not the most exciting one out there. I'm not even going to pretend. There are plenty of people that have way more exciting philosophies that I personally watch on YouTube who talk about their portfolios, and they have some crazy cool ideas, and maybe they can, they can get an advantage by doing some sort of strategy. And super interesting. Here on the Larch Fund, we're a little more boring, and you can see that because I'm currently on Snowball Analytics. Shout out to them. Not a sponsored, but I love their service. And we have right now the current composition of the Larch Fund. So we're sitting right now. I've got this set in US dollars, I believe, but we're sitting right now at $24,418, which is pretty huge for me personally. It's just a big amount of money. And we've got some pretty good profit. We've got about $1,100 in profit, almost $1,200. But if we looked at sort of the chart for this portfolio, you'd have seen that it was much higher in the not so distant past. Let's talk about some of the companies that are in here. I haven't really been adding any new companies, even though there's some I really want to. But just because I'm sort of waiting, I'm sitting on my hands, and I've been looking at, maybe adding a couple different companies, but we'll get into that second element that I think is really core for my portfolio in a second. And I've kept the portfolio consistent. I still have Equitable Group in here, EQB, National Bank. I've added to CNR. I've added to the S&P 500. I've added to. I haven't added any to my Royal Bank position, but just because it was so big coming into building this portfolio. I've added a little bit, I think, to my Enbridge position. I'm not 100% sure. Maybe I have. I've definitely added to my Pembina position, and I've definitely added to my CNQ position. And that takes me into my second piece of my philosophy, which is consistency. So patience is the thing that will get you those great long-term results. Consistency is the thing that makes sure you stick to the plan. What was my plan? I was going to dollar cost average into high quality Canadian companies. And I picked out a list that covers all sorts of sectors in the Canadian market and honestly in sort of the worldwide market. And you'll see I have lots and lots of exposure to the financial market. Now, this is part of why I haven't increased my Royal Bank position quite as much as I've increased some others, because Royal Bank is obviously a big position. You see, it makes up 40% of my overall financial exposure. National Bank, on the other hand, I have increased, mainly because I think it's quite undervalued. It's up to 23%. The part of the S&P 500 that's made up of financials is also 21%, with EQB, which I also think is a fantastic and undervalued company, at that 14, 15-ish percent. So you'll see big exposure to financials, but I'm mindful of it. I don't want to increase it too much. Next is energy. As a Canadian dividend investor, it's almost impossible to avoid energy stocks. And to be honest with you, I don't want to avoid them because I think these have some amazing opportunities for dividends and growth in the not so distant future. And so obviously my biggest position here is Enbridge, but we also have Pembina and then CNQ and then the S&P 500. S&P, big chunk of that, 3%. Is bringing up that 8%, the final sort of chunk of my energy investment. Over information technology. Now, you might be interested, if you looked at the names in my portfolio, you'd be like, man, there's no tech in here. This is my tech exposure here. Information technology, S&P 500, 33% of the S&P 500 right now is IT. And obviously the way they decide what is IT and what is like communication is obviously up for debate, I would say, but still definitely tech, and it makes up at least 17% of my portfolio, which is honestly a pretty big chunk. Industrials. Now here we're split 70-30 between CNR and the S&P 500. I love the Canadian Railways. I talked about this in a video just the other day where I talked about both CNR and CP. I love the Canadian Railways. I think they're great companies. I would be very happy to put my money in there and forget about it and just collect the dividend, reinvest for as long as I work. But there are other industrial companies that are fantastic. They're in the S&P 500, and I'm happy to have exposure to them. Consumer discretionary, haven't really been invested in this space, mainly because of secular trends, to be honest with you. I think the consumer has been pretty beat up, but honestly, discretionary spending hasn't gone down quite as much as I sort of had expected with inflation and interest rates. So I've kind of avoided the sector. I might be interested in building a position, but even without having a specific purpose-built consumer discretionary position, I still have 6% exposure, 5% exposure to healthcare, all through the SPY. Same thing in communication, consumer staples, utilities, real estate, and materials. Now, the one part of this that I want to outline is real estate, which you'll see right here in that tiny little blue sliver on the screen. It's currently 1% of my portfolio, representing about $250. I have been at least researching a little bit about Canadian real estate investment trusts, about the Canadian real estate market, about real estate investment opportunities. But one of the reasons I haven't been putting a large chunk of my portfolio into real estate is because, like many normal retail investors, I already have a pretty big real estate investment and I'm sitting in it. My house. And if I want to be investing in the Canadian real estate market, well, I've already made the biggest investment of my life in the place I live. And most Canadians are like this. Until our stock portfolio grows exponentially larger than it is today, the amount I have invested into this building, this piece of real estate in Canada, is going to be a much, much larger amount than my portfolio. The amount I contribute into this house is going to be larger than my portfolio. So I haven't been really expanding my residential real estate. I haven't been really looking into that space, but there is opportunity. I will say there is opportunity in the Canadian REIT market. And as a dividend investing channel, I feel like at some point we're going to start talking about it. I just have been, again, I'm a little reluctant to invest more because obviously this chart showing how this portfolio is sort of allocated and the sector exposure I have to these different sectors doesn't take into account sort of the other assets that make up my life, like obviously my house. So am I going to change anything? Well, I think there's a couple things I might change, and I might be adding some names in here. One sector that I might be interested in adding to would be looking at sort of the professional services, or another of those sort of uh, good, diversified, worldwide sort of companies. We talked about WSP on the channel. I've talked a little bit about Brookfield. I'm going to talk a little bit more about Brookfield in the coming weeks. I think it'd be interesting to have a little bit more exposure to those kind of companies on the channel. They typically work in the dividend space. They typically grow their dividends well. A lot of them have been growing pretty fast, so there's a couple of great opportunities in there. But apart from that, I'm waiting. And I'm waiting because of what is on all of our news feeds. And I just clicked over to BNN Bloomberg just because I'm a Canadian and I'm in sort of the stock market space. And so this is one of the key sort of Canadian focused stock market sites that is out there. And obviously, I mean, we're looking at 1, 2, 3, 4, 5, 6, 7, 8, like 8 out of the 9 news articles on the front page of BNN are currently tariff focused, which again, I'm getting a little bit worn down by. I'm getting a little bit bombarded by information on tariffs, and I'm sure you are too. And so the question is for me, okay, the tariffs are here. We've been waiting for this. What am I going to do? And to be honest with you, I'm focused on my 2 sort of core principles there. I'm going to be patient. I don't need to do anything Monday morning. I'm going to go to work. It is cold here in Alberta. So it is not going to be the kind of morning where I'm up and excited and ready to go. No, I'm going to take myself on the nice dark drive to work in the morning. I'm going to sit down. I'm going to have a great day. I'm going to go home. The market will be closed and I won't have thought about it. And then I can start looking at what happened, because I'm not going to try and predict the market. And I don't think as an investor, you should either. Now, if you're a stock trader, you're somebody who trades in and out of stocks, and you have a strategy that you've built and you're consistent and you've been profitable, well, then I assume you would have the kind of information and the skill to make some profits on days like this with high volatility. But to be honest with you, this is not the place for that kind of discussion, because that doesn't actually apply to most of us. As investors, regardless of where you are in the world, most of the time, the days with the most volatility, the most emotion, are the days you lose money. Because those days are usually red days, and you're usually being pressured into selling. Or they're incredibly green days, and you're being pressured into buying, because the market is telling you, or the media is telling you, do this thing. It's tough for any of us investors to look at the news and see nothing but negative economic news. Look at our very, very geographically centralized portfolios. So very exposed to the Canadian economy, very exposed to the US economy. These are both economies who are now going to suffer. Oh no, and not be scared. I'm almost positive we're going to see the fear and greed index spike, if they haven't already been surveying people over the weekend. I'm almost positive we're going to see volatility spike, if we haven't seen that already pulled over the weekend. That is what happens when you get news like this. But if I click back over here, I go find the S&P 500, and I show you the all-time chart, I just want you to look at what happens every single time you have a scary day like today. Look at, let's pick a big event in our lifetimes. How about COVID? Look at that. COVID in a couple of days, honestly, the S&P 500 saw its price drop from $322 down to a low somewhere around $248, $250. You could have lost $70 a share in days. But if you just sat on your hands and maybe bought the dip, stepped in, bought when others were fearful, right? It's like the Warren Buffett quote, be greedy when others are fearful when others are greedy. If you just bought then, look how much you'd be up today. I'm buying the S&P 500 in the $500 range. You could have got it for half that during COVID. What about another big moment in our lives? Let's think about the '08 crash, right? S&P 500 drops from somewhere at the highs here in the 247, 250 range, drops down to 80 something, 70 something dollars a share at the worst. Wow. But if you've been buying that whole time, $120 to pay to get $600 is a pretty great return. Every single one of these big stressful moments has been a buying opportunity in all of history. And no, just because it happened in the past does not mean it has to happen in the future. But as of right now, there's nothing saying that this tariff threat's going to be all that different than the 2018 tariff threats that don't even really register on a chart like this. Or really all that different from the 2022 inflation worries, which sure show up on this chart, but still represented a buying opportunity. Almost all of the time in the market will be time in the market. And so I recommend today for all of you, just think about those two core competencies, those two core ideas, patience and consistency. If you are a buyer of stocks, there is no real reason why you shouldn't be a buyer of stocks if they drop basically any percentage tomorrow or the days following. If you are a seller of stocks, well, there basically isn't any reason for you to treat that any differently tomorrow or the weeks after. Just be patient. Don't do it right away. Don't rush decisions about finance. Don't bet short term. I strongly recommend against using options tomorrow. If you're buying options contracts on a volatile day, you've missed the opportunity. If you wait for implied volatility to spike and then you're trading options specifically, you've probably missed the boat. You've probably bet too late. So just be patient. As investors, it's time for us to just wait a little bit, watch what happens, and be ready. I'm a buyer of stocks. I am still in the accumulation stage in this portfolio. I am constantly putting more and more money into it to see it grow. That's my goal. And I have a time horizon of 20, 30 years. We go back to this S&P 500 chart and we go back in time 20 years, back to 2005. I would look like a genius if I was putting everything in even just a diversified index fund like the S&P 500 in 2005. And I had held on until my money was worth 6 times what I had paid. That would look pretty fantastic. We go even further back to 1995, another 10 years, and you're looking at more. You're looking at what, 12 times your money? Compounding is huge. And so as a buyer of stocks, I'm going to buy this week. I'm going to buy the week after. And I'm just going to sort of be a little bit patient. I'm not doing anything Monday. Again, I'll go to work. I'll let the market do what the market does. And then I'll see what happens. And you know what? Maybe that applies to Tuesday and Wednesday and Thursday too. I'll just be out here constantly searching for more interesting companies, trying to learn about Canadian opportunities and sharing them with you guys. That's my goal. That's what I'm going to be doing. That's how my portfolio looks. And that's my strategy for the future. And if you enjoyed this video, you like talking about Canadian investing or investing in general, please do subscribe to the channel and like the video. It means a huge amount. Doesn't cost anything. This week's going to be an interesting one. And so I should have some interesting stuff to talk about. And I'll try to avoid just using the T word a million times. But with that being said, I hope I catch you in the next one.